Good evening from the Oak Bloke. Today's news was very pleasant. The news being that DEC, DEC, Diversified Energy, has acquired or is going to be acquiring Maverick. This video is to talk through that and to talk about my thoughts on this. Um, as readers will know, I've been covering this share for a while, um, and back in December, I talked about what could happen in 2025, and I think we talked about the fact that it had rejoined the FTSE 250. Talked about how the shorts were melting away. The shorts being companies that really brought the share price down in 2024 in quite a severe way. That was kind of, just quick potted history. Don't want to talk about it too much, but there was a short attack and a report written that was full of holes and errors, and it was very well constructed to generate fear, uncertainty, and doubt. I kind of went through it and found about 15 errors and holes and inconsistencies and things that perhaps weren't accurate. Could use a different word there. Anyway, so DEC had a pretty tough 2024, fell out of the 250 and fell back in at the end of the year. As I speak, I think this number has dropped further to 3.7% this evening, I believe. And these are just notifiable shorts of above 0.5%. So I think there's a couple of hanging on for dear life, but good luck to them, I say, because I think get out now before you lose more money. But anyway, I've been saying that for a while. A couple of other things to sort of add as background, and apologies, I haven't loaded up this, but if I load up this, which is the latest, let's just load this up, latest EIA report. Just quickly nip into this. It's quite interesting. So we see demand year on year is up for gas. You can see here we've there's a real cold spell that's hit the US. So I think average temperatures are kind of well below normal. You can see there sort of up to 10 degrees, or so 8 to 10 degrees cooler. Some areas are a little bit warmer than normal, but not many. If you're up north, you're okay. If you're down south and you're feeling the chill, is the gist of this. And obviously this changes day by day, week by week, but we can see that the historic, and this upper dotted line is the upper limit of the 5-year average, that it's still at the upper limit of the 5-year average, to be fair. But we can also see that that is reducing very, very fast. In other words, the stocks are depleting, and we can see things like demand year to year is a lot higher, and also that rig counts are certainly not back at historically high levels either. So that's kind of a little bit of background behind the recent prices. And recent prices, this has jumped around a little bit. It's $4 per MMBTU, which is about $24 per barrel of oil equivalent, which is still jolly cheap. It's about still less than a quarter of the price that the UK is paying. But you can see here it hit 420s, come back down a bit, but today it's jumped back to 4 again. So terms of outlook, in terms of the trading economics, see it as trading at 458. Now, the reason I'm showing you this is I'm going to talk about it a bit later on, so just setting a bit of context. Anyway, yeah. So anyway, I did talk about a few different things in my December article. Talked about how potentially, certainly we can see a reduction of gas production, and of course you could argue, well, that's because some producers have shut production in, that kind of thing. But I mean, it might be as well. There's an alternative theory, and there's some really, really good research into this. I mean, this is some research from um, a research house called Göring and Rosenschwag. I think I've pronounced that correctly. That argues that what we're facing is the Hubbert um, curve, and Hubbert was a very famous geologist from Shell who predicted that production was subject to, once you hit 50% of the reserves, then there's nothing you can do to slow the decline. And this was the prediction, the dotted line, and this was the actual. So you can see here the Midland, and Midland being I think it's one of these. Yeah, it's probably coming under this rest of US, but this is sort of an earlier basin the Midland side of the Permian Basin. So this is an example of where you get the Hubbert curve, which predicts that production will decline after you hit the halfway mark, which kind of sounds sensible anyway. It's like a bell curve effect essentially. So have we reached that here? The jury's out, but that if that is the case, then we're looking at higher future prices, and that's why that is pretty nailed on, if not higher. Remember, it's less than a quarter of of the prices worldwide, and certainly in Europe and Asia. And I think a little bit later on, I talk about yes, here I'm talking about increasing generation for electricity, and we can see the build out of AI, the build out of data centers, the general move towards electrification, um, including electric vehicles, but lots of other things as well, are all tailwinds behind the demand for gas. LNG exports as well. I mean, of course, President Trump is very keen to accelerate those. We kind of see growth of about 3 BCF during 2025, and yeah, and actually, when you look at the inventories of Europe and elsewhere, um, we're not at 5-year maximums, far from it. In fact, I think since I published this article, because this is as of December the 11th, I think this has actually now fallen to the minimum of the 5-year, so of the average. So lots and lots of reasons to be thinking that this is positive even before today's news. This as well was further news about coal methane. So not only can you well prevent danger, because obviously methane is explosive, so it's necessary to ventilate coal mines. That's where you get this phrase "canaries in the coal mine" from, if you didn't know that. So obviously today we don't put poor little canaries down coal mines. We have methane chemical monitoring, and we put in ventilation. But the problem with just ventilating it to the air is that then creates very strong CO2 equivalent impact on the atmosphere, which of course is also a problem because methane is 72 times more warming than CO2. It doesn't last as long. It breaks down after 30 years, I think it is. But whereas CO2 stays in the atmosphere for hundreds of years. So once you put it up there, then it's warming the earth for well, certainly for our lifetimes and for our descendants going forwards 10 or 20 generations. So think about that when you're yeah, anyway. So the upside here is that there's tax credits as well as the ability to, rather than ventilate it to the air, that you capture the methane and send it down a pipeline and sell it. Seems sensible to me. So there's lots and lots of reasons, and we can see here this is the overlay of where all the coal methane projects are, and this is the footprint of diversified uh, oil, sorry, oil and gas, predominantly gas production is. So yeah, a great synergy there where there's probably pipelines and the ability to bring that coal methane gas through for sale without spending vast amounts of capex. So all very positive, all very positive, and there could be some good upside to that, and also there was a little bit around the number of rigs have increased as well. That yeah, so lots of reasons there. I then wrote about it. It didn't take me long. Wrote about it a couple of weeks later because there was some news. This one was yeah, December the 29th, and then January the 6th. There was an acquisition, so dequisition number one. Obviously, today needs to be dequisition number two, I guess. But anyway, this was an acquisition called Summit, which was $45 million, which was 2,000 barrels of oil equivalent per day, all gas. So it is just BOE, not no liquids, and the economics of this look good. So the net profit, the accretive net profit on this, even after taking into consideration depletion and tax and everything, was 4.3 million, which on a purchase price of 45. I mean, obviously that's a 10% return, ROI of 9.7 technically. But again, there's the ability to drive down the expenses. I mean, this 10-10 cost, yeah, that will we see some synergies there, but also the revenue was higher than normal, so that sort of caught my eye as well. So that that was all positive. And then, of course, the bit that's not in this price, that this 4.4 million, this 9.7% ROI, doesn't include any coal methane, whereas this is all very much in coal mining territories and in keeping with this Appalachian, and also that there was deck wells in the same area as Summit's wells. So again, the ability to gain synergies as well, and also apply the smart asset management. And the other thing that I think really caught my eye, and don't think anyone else, I didn't see anybody else spot this and talk. Certainly if they did, they didn't say anything about it. So I think I was the first to say, this intellectual capital that caught my eye. So we're gonna acquire Summit, not just because of its gas wells, even though they produce a 10% return on investment, but there's the upside of the coal methane. But there's also the intellectual capital to grow this segment. In other words, what they were acquiring was people with the skills, with the capabilities, with the knowledge, as part of that deal. So kind of liked it for that reason as well. Okay, so that sort of is the background. We're at 14 minutes already, so the lightweights will have switched this off already. So if you're still watching, well done, because you're not one. And now let's talk about today's news. So yeah, this is the it imagines the delighted reaction of President Trump to the news. Lean in, he declares, and Rusty moves in with well-oiled ease. I like that. I like the thought of that. I mean, it didn't happen. It's just a bit of fun, but that's kind of the metaphorical picture for today. So, what is this news today? So, Maverick, nothing to do with Top Gun. No, no, I'm not even gonna. No, I'll shut up about that. But yeah, Maverick Natural Resources is um, an acquisition. So they've got. So you can see the yellow stuff, yellow stuff being well locations. So they've got well locations in New Mexico, as pictured here. New Mexico, as pictured here. Texas, as pictured here, which is by the looks of things, sort of bordering. Excuse me, bordering into New Mexico. So um, completely the other side of Texas. Texas is a big state, as probably you all know. So not many synergies to any of this, but look at this. We're going to talk about this a bit more a bit later, but of synergies as well around Arkansas, Louisiana. So I think this Wyoming inset is. I don't think this is to scale. So again, there's sort of assets in locations where there's no sort of interactive, but this one particularly, and then this one to some extent. But actually, the thing that the DEC management were very excited about was the Permian and the access into the Permian. They saw that as very exciting. I must admit, I didn't personally share that excitement. I couldn't see the reason for their excitement. If I could have asked them a question, what makes you so excited to be gaining access to? And I know it's a very large production area. I mean that's probably the reason that there's opportunity there. But would it have been better to have like more of a synergy to like more like the West Anadarko? That's surely that would have been more exciting. Like to me, Anadarko was the exciting bit, and the Permian was like, oh, it's just a sea of yellow with no blue. But maybe I'm just being a bit naive. I mean, at the end of the day, they're the DEC management, and I'm not. So what do I know? So yeah, look, key statistics as you see here. I mean, the acquired assets. So this acquisition is going to happen during H1 25. It's probably in about 6 months' time that it closes. So the acquisition is 900,000 acres of land. So there's obviously the existing acreage that DEC have, and the whether 1,100 per acre is can be or is a good indicator. But I mean, if we apply 1,100 to those 900, I mean that's there's a billion there in just um, I know people can get a bit giddy and excited about those. I mean, obviously, when I've analysed it and I went back over 4 years, I mean, yes, it generates a bit of money, but we're talking like 10, 20 million a year. It's not, like, is it going to suddenly, is there going to one day and, oh, DEC have sold 900,000 acres for 1,100 an acre and they've just made $1 billion. Whoopee. Like, are you ever going to wake up at 7, are you ever going to look at an RNS at 7 a.m. that says that? I don't think so. I think it'll be bits and pieces here and there, but that's fine. Like, I'm not saying the reason that you should be excited about DEC is because of those 900 thousand. But obviously, it's part of the equation. You know that something potentially can happen with that acreage. Obviously, it's acquisition of production, and I produced just like a handy sort of how to look at it here. So let's kind of spend a bit of time rather than sort of go through all the words. Let's just sort of look at it this way. So this is the this is as at 3009/24, and so is this. So kind of reasonably accurate, up to date. Obviously, we don't know the precise 31/12/24 numbers, but we can see in terms of million CFE per day, it combines to 1200, and I mean this is the metric I tend to use more, which is 1000 oil equivalent per day, so 141,000 BOE. Adding in 58 gets us to 199, so it's an increase of barrels of oil equivalent. But what's particularly noticeable is that historically the mix is 85/15. And I did wonder about this because, of course, the Summit acquisition changes that mix somewhat. The Oak Tree, it wasn't clear to me where the timing lay because, of course, you've got the Crescent Pass, the Oak Tree. So 3009/24, I was casting my mind back and I was thinking, is it still 85/15, like on the 27th of January? I think there might be a little bit of an adjusting number there, to be fair. But anyway, let's go with what they've told us. That's sort of that's it's not going to make a massive difference to the percentages. But when we mix in 45 and 55, and what I've done is a weighted average here to get to a 73% weighted average overall and a 26 here. And over here, I've done a little handy thing where I've just said, what does it mean per share that you own? So, assuming that you're a shareholder, you'll have bought the shares. I mean, let's say you've bought the shares at $16 because that's kind of the price today. Let's have a look at what the price is today. 16.28 to you, sir. Is as I speak. What's it? 5 to 9, 16.30. There we go. So up 3.3% on the news, which is okay. That's fairly decent. It's a bit less than I thought it would go up by today, but hey ho. I'm obviously very positive on this. But anyway, yeah, so we can see that there's a 78% increase on liquids, which is very good because obviously liquids sell for a higher price, and last year 2024 natural gas prices did hit very 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 low levels. Whether the fullness of time that it could go the other way, where actually having more natural gas could be better in the future. Potentially, I mean, if natural gas reverts back to parity to oil, could it overtake oil? Yes, I think it could, potentially. So this mixture is obviously a positive thing. Let's move on. So revenue. Now the interesting thing is, even though this is much smaller, the revenue is much higher, and the explanation there is because it's 55% liquids. That's kind of shows you how much of a difference it makes to be kind of more or less half and half rather than sort of 5/6 and 1/6. Is that the revenue is far higher on average, and the earnings as well. Now the earnings for Maverick, again, really impressive numbers. So 380 million and 555 gets us to 935. And over here, this is interesting. So based on 47 million shares, your adjusted EBITDA has gone from $11.76 per share, by adding in Maverick. So Maverick shareholders were earning 17.92 per share. And when I say per share, I mean I obviously don't have the shareholders of Maverick. What I'm doing here is I'm taking the 21.2 million shares that were issued and sort of saying, you know, like obviously these guys have had 207 million, which is $9.76 per one of these shares. So you've obviously got to factor that in, and overall that is $3.03 per share combined. So this is the combined value here. Excuse me, interesting as well that taking that 47 million shares and 21 million shares, and that was the debt pre-merger. I'd say merger, pre-acquisition. That was the debt that they brought with them. So combined, we've gone from being $34.72 debt per share to now only having 34.19 debt per share. So our new Maverick deckhands have alleviated us of a little bit of debt per share, which is quite nice. But yeah, I think the things that are the standouts for me is that the adjusted EBITDA per deckhand share is up 16%, free cash flow is up 8%. And these are just the historical numbers. I think the thing I would point out here is that this doesn't take into account a single penny of synergy, any single rationalization of overheads, the G&A as they call it, general and administrative. The G&A for DEC is 120 million a year. I mean, if the Maverick is, I mean, on the basis that they're about half the size in terms of production, say theirs is 60 million, might be higher actually, probably is higher. But I mean, if we can, or if half of that can be cut as a synergy, I mean, that's 30 million. That's 30 million, and that that 30 million would just feed straight through into that number there. So, if that were 375 million, for example, free cash flows just increased 18%, and that's just purely not any synergy other than rationalization of overhead costs by combining the two together. Well, you don't need as many accountants, you don't need as many managers, you don't need as many, all of those sort of overheady costs can just tuck away as well. So yeah, look, I mean, it's, even if there's just a 30 million synergy, which actually is kind of pretty, I think that would, if there's only that, then it would be quite disappointing. But if it's only 30 million synergy, then you're looking at an 18% increase to free cash flow per share, and that's pretty encouraging. And yeah, so lots and lots of perhaps just quickly show you a few other things that I thought were interesting. Obviously, the enterprise value by earnings drops and improves by 10%. Leverage improves by 17%. Okay, the PV. For each, I mean, and this is an interesting thing, based upon there being a PV10 of 3.9 billion, and that we're acquiring 2.1 billion of PV10 of now this is the proven resources. So this is the proven, developed and producing is the difference, that this one's lower. So not all of this 2.1, these should be dollars. The not all of the 2.1 is actually producing. There's 400 million of undeveloped in this number here. But yeah, taking that number as the number, there's $99 per one of these shares, and so there's a sort of a $5 upside per share, 6% improvement to your future 10% discounted present value of future cash flows over the lifetime of owning DEC, which is see, very, very good. So is this accretive? Well, the numbers say that it is, and that's the proof. And anyway, moving on, we're now at 30 minutes. So I did think I was going to take me probably best part of an hour. So dear me, if you're still with me, you're doing really well, because I'm sure 99% have dropped off by this point. Quite literally, that's the sound of snoring you can hear. Anyway, so yeah, it's 1.275 billion that is being spent. Another little graph and chart to share with you. I think again, maybe I think so many things are interesting, but let's just consider this, that the accretiveness doesn't stop there, because what I've done is I've taken all of the acquisitions and the disposal. Which one? The Can't remember this. Oh yeah, sorry. This one is the net of the DP Line disposal, and then the Texas 2 and the Crescent Pass acquisition. So that's kind of combining all three together, plus the Oak Tree deal, and then plus the Maverick deal, which is this one here. So the justification is that the 1.275 billion is in return for, so to speak, 380 million of EBITDA, 480 million barrels of oil. Now, that number there, by the way, I've worked out by taking the 2.1 billion PV10 and basically just creating a pro rata. So that isn't a disclosed number, but I thought it was reasonable. As I say, 2.1 billion PV10. So obviously, just on that and that, I think somebody else said this, that there's 825 million there. 58,000 barrels of oil a day. The no, I don't think that should be there. Don't think that should be there. And yeah, well, I think we can probably lose those ones as well, but that's probably the key. And actually, I mean, I think it's worth saying that EIS have 50 billion assets, $50 billion of projects that they've committed to. I think their assets under management are something like 25 billion. They're not a small backer, so they are kind of like another Oak Tree. So the fact that there appeared to be the parting of ways with Oak Tree, it's actually quite interesting, because the Texas 2, this one here. So one of the shareholders was EIS, I think, was revealed today, and that was kind of around the same time that Oak Tree happened. So I wonder whether there was a little bit of a mutual parting of ways with Oak Tree, where the future was EIS, and they knew this a while ago. Obviously, this happened. Was it September last year or August last year? So 6 months ago, and obviously this sort of happened a bit later in the autumn. So yeah, EIS is the new Oak Tree, so to speak. So that was another positive that I should probably uh, plus EIS. Anyway, when you net it all together, so taking all of those, so basically what all of the acquisitions and all of the disposal, netting them all together, delivers is for the cost of 1.31 billion. That's the outlay, and obviously some of that's debt, of course. It's delivered 516 EBITDA earnings. Now, obviously, that's sort of a historical number, and at the time of the acquisition, that was the EBITDA that was being acquired. There was that sort of tiny 1 million of dividends from DP Lion that is. I think this one was to do with Crescent Pass, that there was some acreage, and there was a 5% free carry on the development that was going to happen on that asset. So DEC don't get their hands dirty. Drilling's for fools. Don't put the money in the ground. Take the money out of the ground is kind of the strategy, which seems very sensible strategy to me. And then yeah, obviously we've seen a long history, in fact, of cost synergies being delivered and being achieved. The acquisitions in total have brought 76,000 barrels of oil per day, and that's net of the DP Lion, which was quite a large disposal. So even taking into account Texas 2 and Crescent Pass, that was a net. I think it was 29,000 that was disposed. The PV10 was 2.8 billion. So you can see there, I mean, that is 1.5 billion difference, discounted at 10%. So very, very, very big difference. The higher proportion of liquids. So we're now today at 26.7, whereas the historical was 15. And I think if we went back even further, it was lower than 15 prior to, because uh, I think the Tanos acquisition increased the oil by quite a bit, and the move into the central region, because obviously historically it was Appalachian only, and Appalachia was, I think, nearly 100%, if not 100% natural gas. There's still the 20% ownership of DP Lion, so they sold 80%, not 100%. But then there's also all of this acreage. So there's 170,000 that came with East Texas. There was 900,000, or the 400 million that was announced today. So all of that for 2.8 plus all of the other things here. I mean, what price do you put on, on the acreage and so on and so on. So far in excess of the cost of 1.31 billion. Also talk about the sort of model this into the profit model, so we can see now I've made a couple of adjustments to the profit model today. So I've kind of reflected in the higher price, and that higher price, by the way, what I've done is this 24.58 that we see here for 2025 is based upon this 26.73 mix, so the improved mix. And what I've done is I've taken hedged and unhedged. So I'm kind of assuming, I mean, you can see here this isn't particularly aggressive. The unhedged, I'm taking an average of $3 MMBTU. The hedged at 320, which again I think is actually lower than, I think the hedged is more like 335, if I'm not mistaken, for 2025. But anyway, I've kind of gone in a bit lower to get to a 24.58, but that was quite a lot higher than my prior assumption, which was 23.95. So that has all fed into basically just higher surpluses and higher profits. What I've done is I've factored in higher interest payments, higher. Now I've increased. You can see here I'm tripling the asset retirement obligation. The detractors will be keen to hear, keen to see. And I'm not saying this is what DEC are going to do, but you'd imagine that there's going to be a sort of an increase to that ARO level because of obviously the increased number of wells, the acquisition. But whether it'll be as much as 82 million, I mean, in fact, it almost certainly won't be. But factoring that in, factoring in a higher depletion, factoring in just keeping the next level static. So this profit margin here is basically this EBITDA and this EBITDA feed into this EBITDA here. So even under this model, we can see some really, really strong free cash flow generation. So obviously that's a year's worth there. So that's 1.3 billion of free cash flow predicted. That liquidity is well in excess each period, each quarter, even after taking into consideration dividends. So again, actually, if you take that minus 21 and that plus 40 something, again, that's where you see the prior 64 million dividend could be afforded, and that's with fairly conservative assumptions. I think, as I say, I mean, I'm not, I'm assuming 72 barrels, 72 on the the price of oil. I'm assuming $3 on the price of gas, $3.20 on the hedges, 24 on the NGLs. I mean, it's not very yeah, it's easily beatable. And these costs of 980 BOE. Again, I'm not really factoring in any particular synergies other than just a small one here, which I'd had in the model anyway. So, but we'll that's a continually evolving position. The other thing quickly to say is when we can, and actually I did want to sort of highlight this because this is important. The This is the acquisition of Summit a couple of weeks ago, and then this is the acquisition today. The one aspect that I particularly, when I saw it, I thought, wow, was this here, that when you look at the acquisition cost, so the acquisition cost being that 1275, compared to the 480 million barrels of oil equivalent, which is that 2.1 billion PV10 is kind of that's where that's coming from. DEC are paying two 2.66 million per million barrels of oil equivalent, which is, I mean, as you can see it here, it's about half the price of every other acquisition in the past. It's very, very impressive. Obviously, I don't know that number definitively. I'm inferring that from that. But it seems reasonable numbers to me, and I think this as well. I mean, yes, the per barrels of oil per day, this is 58,000 barrels of oil a day at that cost there. So you're paying 21.98 for sorry, let me start again. You're paying 21.98 million per thousand barrels of oil, or in other words, you're paying $22,000 for each barrel of oil per day, which is higher than the historical ones. I mean, not higher than this one, which was the East Texas Conoco deal back here, but obviously higher than Crescent Pass, higher than Oak Tree. These were obviously all a bit cheaper, but because this one comes with so much undeveloped, really, the sort of judging it just on the flowing barrels of oil is kind of a bit unfair. That we know that 25% of that PV10 is actually undeveloped. So actually, if you take that 22 and take out that 25% of undeveloped, I mean, you are at about 17,000 per BOE per day. So 17,000 per barrel of oil per day flowing is cheap, really cheap, actually, really cheap. So yeah, look, I mean, I think it's, from all the analysis I've done, it looks fantastic. And the numbers are there, that like 17,000 is a good number to be paying to acquire those assets, especially as those are assets that are proximate to the Gulf Coast. Now, that's the other thing that I guess is a really, really impressive metric. So I've covered that with you. This is obviously just pretty much the RNS, so I'm not going to read this out. I mean, you obviously have read it yourselves, I'm assuming, and I've obviously covered the key points with you on this presentation already. So I guess the final things to say is that we've covered this and we've covered this. I think the final things to say were I think we've probably covered almost all of this actually. So I think the final things to say were the yeah, I mean, there's obviously aspects like the number of basins that are so there's just sort of less concentration risk. So covering 5 basins rather than 4 is, there's access into the Permian Basin. As I say, the DEC management seemed very excited about it, so we'll wait and see, because obviously they're excited for a reason. So that's all positive. We've talked about the increase to production. That's all positive. This was something I'd call out. Now, obviously, 6 months from now, the hedges are all going to be completely different. So, whether this reflects what the world will look like in, say, June of 2025, who knows? But I mean, the fact that these guys are very actively hedging production, and what I noticed actually was when you looked at their past results, that they actually achieved some really good uh, hedged gains, actually potentially better than DEC itself achieved. I think I'm right in saying that when you went back, I think it was the 2023 results, that Maverick managed to make a profit when DEC made a loss. I might have that the wrong way round, but I think that's actually a positive as well. The fact that there's only 10% declines, again, really positive. So same as DC. So there's no sort of, we're not acquiring assets that are dropping sharply. That 10% decline is good. Yeah, I think the other, I particularly call out this. So the overlap, this 36 on 199 is 18%. So, I mean, 18% of production, again, synergies. Well, if we could drive down, say achieve a 10% reduction, 10% reduction on 18% would be 1.8%, which, obviously that's not much, but that's 18 cents, which, let me just put my profit model back, just to sort of show you how much of an impact that would be. Well, if on 18% you can get a 10% saving, that would take that there, and obviously what we're interested in is, well, what happens over here? And you can see, it chucks a couple of million onto the net profit to kind of get there. So it all adds up. It's about 2 million net profit per quarter. So that's 8 million a year. That's 8 million additional profit a year just from that. So I mean, we talked about 30 million on the G&A, perhaps, and then I'm sort of saying 10%. I mean, what if they could get more than 10%? Obviously, you can see there's a lot of blue in amongst the yellow, and I don't think there's so much yellow in amongst the blue. There's a bit here, isn't there? But there's clearly some synergies where the folks that go out and manage these wells will be able to, they'll be able to reposition people to be better, more efficiently sited to manage clusters of wells and cut down on travel and those kinds of costs, and also just to rationalize things like the IT monitoring and so on. So yeah, some really good. I mean, if you actually compare to some of the competitors, the 980, if that's going to be the actuals, I mean, or the 1023, the 1008, these are actually quite a lot higher than, for example, EQT. EQT manages to produce natural gas at about 750 per barrel of oil equivalent per day. So there are further efficiencies that could be achieved with greater levels of concentration, with greater levels of scale. So yeah, if we could, if DEC could get down to those kinds of levels, again, I mean, let's just sort of see what happens over here to profit, and the answer is that again, that sort of adds about 16 million a year to the metrics. So yeah, it's all good stuff. It's lots and lots of areas potential for upside. This 750,000 acres, and again, I sort of said, well, that works out at 825 million, and get all giddy about that, but they certainly talk about doing JVs and deals to offset this. So let's wait and see. I mean, they've achieved it in the past. I just don't think we should get giddy and excited where as I say, we're not going to sort of see deals into the sort of nine figures, but we'll see deals perhaps in the eight figures, 10, 20, 30 million deals, million dollar deals to offload some of the unused acreage that at the end of the day, it's not in the price at all. So even if they only get 30 million, I mean, that's still about 60, well, about 50 pence on the share price, which is 50p that's not there now, and that's just sort of one deal at 30 million. So yeah, lots and lots of opportunity to build scale. They're now number one in this basin. That's something that I think I sort of said here, who saw that coming? And it's true, isn't it? Because everyone's always said, oh, DEC is this small weird player that doesn't sort of do the normal thing and drill for oil, drill for gas. It sort of just acquires these rusty old wells that nobody wants. But the reality is, well, hang on a minute, like, this is the number one player in that market, in that part, in that territory, in that basin. So accelerated deleveraging, obviously the cash flow improvement is really impressive, and that 8% boost per share will help in accelerating the deleveraging. So will we see some efficiencies? I mean, I've pondered here, so yeah, maybe we could get, for example, a 30 million saving just from sort of merging G&A costs. Are we going to see an enduring platform for growth? Well, yes. I mean, obviously, the greater exposure to the Gulf Coast is really positive. The higher proportion of liquids, really positive. Strength in margins, really, really positive. I mean, can they achieve synergies? Well, we'll wait and see. I've not factored any into those numbers that you see there. There's nothing in there to say. And I saw a broker note saying that they thought that they would achieve 10 to 15%. Now, did they explain how or what led them to think 10 to 15%? No, but I mean, could it be 10%, 15%? If it were, then obviously that again, that's about a $50 million upside to the numbers, to free cash flow and to profits, and 50 million is that's about 50% on top of the current dividend. Just kind of put that in context. So lots and lots of reasons to feel positive, I think, about it. Certainly not negative. These six elements here are kind of reflective of that last slide of the presentation deck, and the last piece here was the multiple re-rate opportunity. So I mean, I've left it on multiple re-rate question mark because of course this share has been well, it obviously was way down in the doldrums. It dropped down below £9 a share, and now is at £13 a share, 13.10 I think it was this evening. Anyway, it's clearly sort of been in the wars a little bit. So will we see it suddenly strike upwards to 15, 17, £20? I don't know is the answer. I think I think certainly the annual results will be very interesting. I think the proof point there will be a potential for a re-rate. I think if there's evidence in there of some real serious upside through the coal methane, if we see some progress in that, and we'll certainly will, I think, see progress in that in 2025. So there's that's positive. Obviously, this deal closing and the seeing the results, the Q3 trading update 2025 will be another reason. I think if we see further news on the build out and the increase of electricity generation under Trump and increase in LNG exports under Trump in 2025, I mean that at some point has got to be positive for natural gas and natural gas prices and for sentiment towards natural gas as a sector to be excited about, because it's clear that in 2024 it was not an area to be excited about whatsoever. So yeah, anyway, that concludes it from me. Hope that's been a useful 54 minutes, nearly an hour. So if you've stuck with me for that whole hour, well done to you. I'm sure there'll be people saying how boring it all was and how awful it all was. Well, don't watch it. Don't, nobody's asking you to watch me uh, pontificate about DEC. So just just go and do something more interesting. Please do, feel free. But look, if you enjoyed it, if you enjoyed this video, none of this is advice. If you enjoyed it, if you felt it was valuable, and you want to say thank you, can I just sort of end by talking quickly about this, which is on my website, so Oak Bloke, theoakbloke.substack.com. I'm looking for people that do appreciate these videos and my Substack to help towards raising funds for Emmaus. So these guys are working with a number of homeless operations. So they provide a home for homeless people, ex-homeless people, as they become, and those people then contribute back into the businesses that Emmaus run. So those can be like furniture shops, coffee shops, stuff like that. So it's giving them a hand up, not a hand out, which I really like. And they're not a big charity, so if you are able to help, if you are willing to help, I'd be very grateful. Thank you very much to all these people that have helped. There's a lot of people that are helping and have helped, and I really appreciate that obviously it's hard to kind of everyone wants a bit of your money or whatever, but this is not for me, it's for this charity. So if you haven't helped and you want to, please do. All you need to do is click this button, give now, and it's justgiving.com. Just obviously give gift aid if you can, and that's everything from me. Cheerio from now. Oak Bloke signing off. Goodbye.